Hi, Larry Berman here, and here's what's on my radar this week. Well, it's not much different than in recent weeks. The debate around inflation, job numbers came in today, a little bit soft in Canada, but in the US, much stronger than expected, much stronger than some of the secondary type indicators like ADP and some of the sentiment surveys suggested for the month. So the narrative that came out generally after that is the Fed is, they're going to like that number. They're going to be one step closer to tapering. We heard Kaplan on Friday update his thoughts there and confirming that notion. So the debate on the Fed is raging between tapering and not, or really the beginning of it and the timing of it, weighed against inflation. Big senator from West Virginia sent a letter to Powell this week and said, I'm worried about inflation. You guys might be getting behind the curve. He didn't say it like that. I'm talking in market lingo. And what are you going to do about it kind of thing. So there's a lot of pressure on the Fed here. We think still the Jackson Hole event will be enlightening for the market, with the September meeting the kickoff to the tapering. That's a little bit ahead of market expectations. Markets are thinking they tell us in September for later in the year, because largely they will not have seen at Jackson Hole at the end of August the payroll numbers for August, which would come in the first week in September. So there's a little bit of that narrative there in terms of timing of things. I still think Jackson Hole is going to be a big event. We've talked about Treasury supply and the impact to the market. Tax revenue's been greater than expected in recent weeks, and so the Treasury doesn't have to fund as much right now, and that's been a big factor, continuing to push out that big bond supply. Now, after the payroll report on Friday, we saw bond yields back up pretty significantly from the lows that they made earlier in the week. And so again, this narrative about yield and how stocks are pricing relative to the yield. Goldman Sachs came out with a market call of 4,700 by year end and 4,900 for the S&P by the end of next year, largely predicated on interest rates staying low. So that's the key here. Once the Fed starts pulling back, we will see how the equity markets respond, and my bet will be on the negative side. There's a lot of people thinking still very positive here, so we'll see how that all plays out. Bull and bear picks of the week. When we're talking about interest rates and sensitivity, you have to look at currency markets. We saw the US dollar gain a little strength after the stronger than expected payroll report, vis-a-vis the European currencies, the Canadian dollar, and more importantly, emerging market currencies. The Delta virus is spreading rampantly through lots of parts of emerging markets that don't have the vaccination rates that some of the developed markets do. And so they'll get through it too, just like the developed markets. And so there's opportunity there, one on the currency side, two on the market side. We nibbled on Thailand this week, THD ETF, for the first time in a long time, buying into the bit of weakness here we're seeing in Thailand. These secondary Asian emerging markets like Thailand, like Vietnam, like Indonesia, like Malaysia, very, very attractive longer term as we look out over the next few years for sure, and even beyond that. On the bearish side, US large cap tech, still not a great response to terrific earnings. That is usually troubling. And when interest rates start to rise, that's the sector that's going to get hit the most. It benefited in the last few months tremendously from falling rates. And I'm betting and suggesting that rates from here are going 25 or 30, 40 basis points higher before they go 25 or 30 or 40 basis points lower. Have a great week, everyone.